In trading, there are many different types of strategies. However, each one is designed to take advantage of a specific market condition. For example, using a trend-following strategy in a consolidating market will likely result in poor performance. But if the strategy aligns with the market conditions, that's when it can perform at its best. And this applies equally to manual trading as well to the development of trading bots. So, how can we identify market phases to maximize performance and consistency? That's exactly what we'll cover in this video. First, we can classify most trading strategies into three main categories. The first one is trend-following strategies. These ones aim to identify an established market trend and enter a position at a specific moment. Here, we have an example of a strategy where entries occur on price pullbacks. With this type of approach, correctly identifying the trend is crucial, because to maximize the profit probability, we generally only enter in the direction of the trend, in this case using long positions, since the trend is bullish. The second type of strategy is range trading, also known as mean reversion. With this approach, traders typically look to enter positions near the extremes of a consolidation phase, aiming for a price reversal back into the range, or even to the opposite side of it. The key difference from trend-following strategies is that positions can be taken in both directions, meaning both long and short trades are viable in the very same range. However, for this strategy to be effective, correctly identifying a range is crucial, something that's easy to see in hindsight, but much harder when the range is just starting to form. Finally, we have breakout strategies. Here, the first step is to identify a consolidation zone or a price compression phase. Then, when a strong price movement and volume increase is detected, a position is taken in the direction of the breakout. An alternative approach is to wait for a pullback where the price briefly retraces towards the breakout level before resuming its movement. Again, market conditions play a key role. The challenge is to identify a valid range followed by the start of a strong trend, while avoiding false breakouts that could trap traders in losing positions. As we've seen, each strategy relies on correctly identifying market conditions to maximize efficiency. To increase consistency, the goal is to use a systematic and objective method to classify market phases. This way, we can ensure that the chosen strategy aligns with the current market environment, reducing unnecessary risks and improving long-term performance. A simple method is to use a moving average. For this example, I've applied a simple moving average, an SMA, with a period of 20 candles. However, this reasoning can, of course, be applied to other types of moving averages. One initial approach is to determine the trend based on the price's position relative to this moving average. Here, the price is below the moving average, so we conclude that the trend is bearish. And here, the price is above the moving average, so the trend is considered bullish. Let's build on this approach and display in green the areas where the previous candle's close is above the simple moving average. And conversely, we'll mark in red the areas where the previous candle's close is below the moving average. Here are the results using this rule. What you've probably noticed is that this market classification is very noisy. As a result, if we were to use such a method to filter trends for a trading strategy, the results might not be very convincing. Instead of applying a rule based on the price's position relative to the moving average, let's try using the direction of the moving average itself. But be aware, this is something not to do with an exponential moving average, an EMA, as its direction will always be aligned with the price's position relative to it. Here, when the simple moving average points downward, the trend will be considered bearish even though the candle closes slightly above the yellow line. And conversely, if the moving average points upward, the trend will be considered bullish. With this classification, the results are different. In the first part of the chart, we notice that the classification is much less noisy than before, with well-identified trends when they are strong. However, in the second period of the chart, the alternation between bullish and bearish detection is reduced, but still too frequent. So this method works well during periods where the direction is clear, but can mislead us during consolidation phases. Thus, it becomes necessary to detect ranges so that we can apply our trend following, consolidation, or breakout strategies only when the probabilities are in our favor. So far, we've used just one moving average, but would using multiple moving averages help improve the results? The answer is yes, and I'll show you right away. Before we continue, if you enjoy this video, don't forget to like and subscribe. And also, if you have any suggestions or feedback, feel free to share them in the comments down below. And if you want to learn more, feel free to join the community Discord server. The link is in the description. Now, let's get back to the video. In addition to our simple moving average with a period of 20 candles, let's apply a second one with a different period of 50. To define the trend direction, we will use the relative positioning of these two curves. Typically, when the short-term moving average, the yellow one, is below the orange one, the trend is considered bearish, and vice versa. With this strategy, we notice that the entire first period is correctly identified as bearish, which was not the case before. The bullish period is also well captured. However, this approach is still not perfect as it shows some lag in detection. Indeed, we can see that the price rose significantly before identifying the trend change to bullish. This means we could end up trading a bearish trend by mistake and be on the wrong side of the market. That's why the method I'm going to present next is very interesting. Moreover, we can see the emergence of a bearish trend here, which could be exploited using a range strategy. How can we eliminate trendless zones and reduce detection lag? To achieve this, we need to define a more restrictive criterion. The one I propose is as follows. We will consider an uptrend when the short moving average is positioned above the long one, as before, but we will add the constraint that both moving averages must be pointing upwards. For a downtrend, the reasoning is similar, but reversed. Everything else will be either a consolidation period or a potential trend reversal. Let's take a look at the results of this method. During strong trend retracements, the trend is potentially changing, which is detected in yellow. These are moments where we could wait for confirmation before taking a trend following trade, so as to avoid being trapped by a trend change. Whereas this long period of indecision is not only, but mostly classified as a neutral zone. Is it possible to do better? The answer is yes, and that we'll see in the next episode. If you liked this video, don't hesitate to give it a thumbs up, to share it, and let me know what you think in the comments. And if you want to learn more about trading strategies, indicators, and the pitfalls to avoid, I invite you to subscribe. That's all for today. It was Azure Algo Trading. Au revoir.